Well, this end of 2015, obviously an interesting year for the S&P and the Dow and global markets in general. And Bob and I wanted to kind of share some thoughts about what we've been through and kind of where we're headed. Clearly this is the classic theme, the S&P and the Dow after 33 dips. If you bought those dips in 2015, you didn't get much return as you might have in 2014 or prior years.
In fact, if you bought the dips in prior years, you almost always would do well.
Always did well. That strategy isn't working when the Fed isn't supporting the markets like they did in the prior years. And to us, that thesis hasn't changed. The Fed stopped printing money in October of 2014, and if you did the math from October 2014 till the end of this fiscal year, you lost money in the S&P and the Dow. So market didn't have the support of the great manipulator, the great Fed. And in addition to not having the quantitative easing, at the very tail end of the year, the Fed finally raised rates 25 basis points. So in addition to not pumping in money, they slowly and minusculely tightened the money supply or tightened the interest rate. And so, that also had an impact on the return of the market. So without that support from the central government or the central bank, you don't see a robust S&P or a Dow. The other thing I think that's interesting to note about the S&P in particular are the big names like Facebook and Amazon and Netflix and Google that have massive, massive market cap increases in 2015, reminded me a lot of Microsoft and Dell and Cisco in 2000 during the dot-com era, companies that, as we've talked about, are still good companies, but were massively overvalued then and kind of came back to earth. Amazon, I last read, is traded a 985 PE, so huge, huge multiples there.
And they are driving the market. Without the top 10 players in the S&P, the market would be down. I think the S&P down almost 10% or more. So not only are you seeing that issue, but you're also seeing a lot of earnings issues in general. So earnings, as you were saying, go ahead.
Yeah, I think in the last 12 months, earnings are actually down from last year 15%. So you've got earnings depression, you've got massively inflated FANGs, the Facebook, Amazon, Netflix, and Google, kind of holding the S&P up, but really kind of depressing earnings. In addition to that kind of tailwind or headwind, of depressed earnings, you also really have these massive sovereign wealth funds coming out of Norway or Saudi Arabia that are typically making bids on the market, in other words, buying. I think this year you're going to see a lot more offerings. These countries and these sovereign wealth funds need money. They're going to be selling a lot of their stocks and bonds and real estate holdings to get some money. More pressure, I think, negative in 2016, which I think, Bob, we talked about, you've written the aftershock. We've been watching these markets since the support in 2008. I feel like we're getting closer and closer now to that, not aftershock, but that trend correction seriously down until the Fed will have to print again.
What you're going to is, we've said all along that without Fed money printing, the market's going down. And it did, but not by much this year. And frankly, it could have been a toss of the coin at the end of the year, whether it was up or down. What we're really doing is waiting for when it goes down. And I think that time is coming nearer rather than later. And I just see that because animal spirits did not rally at the end of the year to push it into positive territory. That was bad. We obviously kicked off the new year with a thud. Could have been the worst opening in 85 years. We had an end of day rally that made it only a terrible opening rather than a god-awful one. So I think you've lost some of that spirit, partly for the earnings reasons, partly it just takes a while, and people move out of the old bubble mentality. But you're right, they're big headwinds. The sovereign wealth funds are certainly not buying, and will be selling. I think the corporate buybacks will continue pretty strongly. That's going to be a help. But in January, usually about 5% of your corporate buybacks are done. So January's been a slow month. That's part of the reason. So, I'm ready to say we're at a point here where I think you're definitely looking at a much more likely down market than an up market. Never can say for sure, but I think there's no question going ahead that what we've seen in the last few weeks and certainly the last year tells me that the change is coming relatively soon. I don't think it's going to be this summer. I think we could easily see some problems in January, February.
Yeah, as we're already seeing it already in the first week of the market. I think it bears repeating. It's worth sticking to our knitting and keeping it simple. These things we've talked about over and over. When the Fed isn't printing money, when they're actually raising rates and they're not supporting the markets, these markets, which have been in massive bubbles, are not going to behave as they've done in the last 8 years.
Right.
And so we can expect, especially as we're raising rates and not printing, this market to dwindle. And I think that's what we're seeing.
And in general, I think the takeaway from that, and final thing, is that anything you look at historically, it generally is not going to be a good guide, because we are in such a different era of this massive dependence on the Fed. And I think people see that. I'll use an analogy. It's kind of like if you're going down a runway and you're trying to take off and you're going faster and faster and faster. If you don't take off, people start to realize you're in for a big problem. And I think that's kind of where we're heading in 2016 and 2017.
Good point.